Okay, in this section we're going to talk about basic fundamentals, and I really do mean a very basic overview of how fundamentals affect the price of currencies. Now, I'm what you would call a technical trader or even a sentiment trader, because that's what I'm looking at. I'm a short-term trader, short to medium term. I do hold positions sometimes for a week or so, but still, that's considered short-term. Fundamental traders or macro traders or more position traders are holding on to positions for periods of time, for months, years potentially, because fundamentals don't change that often. Now, there's a lot of folks out here that will call themselves fundamental traders, but they're really sentiment traders. If they're trading off of the intraday macro and micro releases that we have from day to day, they're really trading off the market sentiment. And it's really important to understand the difference, because the market focus changes. Okay, the daily reactions to those fundamental releases is going to change based on the market focus. Let me give you an example. Right now, the market has been focused on the Fed as far as the U.S. dollar is concerned. The market focus has been on potential rate hikes for the June meeting. And the Fed has consistently talked about being data dependent. Since the Fed has talked about being data dependent for their decision to raise rates, the market has been very sensitive to daily data releases. So in this case, right now, the market, when it sees good news come out from the U.S. from a macro or micro point of view, let's say we get a good GDP number or good labor numbers, the market's interpreting that as potential rate hike. Okay, the Fed's going to look at that as potential rate hike. Rate hikes are good for a currency's valuation. The U.S. dollar strengthens. Okay, that is market sentiment. That is not fundamentals. Another example, 2008, after the crash, the market went risk averse. So what happened then? What happened then? The market was focused on the global economy. The market was focused on a global picture at that point. And it went risk averse. Now we know a risk averse market, money flows into safe haven currencies. Safe haven currencies being currencies like the U.S. dollar, the Japanese yen. So at that point in time, when we had a good GDP number come out from the U.S., it appeared to be good for the global economy, which in turn saw money flowing out of the U.S. dollar into the higher yielding currencies. So we saw the U.S. dollar weakening on the back of good, essentially good fundamental data for the U.S. because the market, the focus was in a different place. The sentiment was different. So the reaction to that data was completely opposite of what it is right now. I remember during that time period, folks that don't have a good understanding or a good handle of this didn't understand what was happening. Okay, you constantly heard in chats and on message boards that we had strong GDP numbers, yet the U.S. dollar declined. And a lot of traders had a hard time figuring that out. Okay, but it all comes back to what the focus of the market is. Okay, market sentiment. And as a short-term trader, that's what you have to understand. Okay, but anyway, let's go ahead and get into some basic fundamentals here so you have an understanding of how things work with the economy and the currency valuation, things to look for, things that really matter to us as currency traders. Look, we're not trying to be economists here. We're not trying to decide policy. Okay, we're only trying to trade currencies and make money. That's what we want to do. Okay, we want to trade currencies and make money. So we need to understand, have the understanding of how the fundamentals affect us as traders.